In late 2001, drawing on the experience and expertise of the best-in-class Dealmakers, the M&A advisor, together with Merrill DataSite, the leading provider of virtual deal management services, launched the Best Practices of the Best Dealmakers series. This series is now delivered every 60 days and features the insight, perspective, and guidance from some of the most active dealmakers in the market today. And earlier this fall, we actually published the first edition of our Best Practices of the Dealmakers book, featuring the contributions of over 50 dealmakers. And we are on track to launch the second edition early in 2014. If you're not already a subscriber to and reading, and it's something that we provide to all of our constituents, over 300,000 around the world on a complimentary basis, please let any of our hosts here today know. It'd be our pleasure to email those out to you. Today we're honored to have four gentlemen with us who I think, whose adherence to best practices has certainly made them leaders in their industry. I'd like you to welcome our 2013 M&A Advisor Summit Chair, Marshall Sonnenschein. Marshall is the chairman of Sonnenschein Partners, also a professor of economics and finance at Columbia. And Marshall is going to introduce our panel and lead a conversation about the narrowing of M&A and the significance of strategy to justify and drive deals with both corporate and even private equity buyers. And if you're not already in receipt of it, Marshall's most recent Market Monitor, written for the M&A Advisor, is available to you at the front. This was released in conjunction with the London Daily Telegraph in late November, and is being released here in the United States after this discussion today. Marshall?
Thank you, David. Good morning, everybody. I have the pleasure of introducing three gentlemen who are friends and clients from the M&A business. When David asked me to organize this panel, I was thinking about how much M&A has changed over the last quarter century that I've been in the business. I think over much of that period, M&A was largely dominated by headlines in the financial world, the leveraged buyout business, beginning really with the 80s and a seminal piece at Harvard called The Eclipse of the Public Corporation, which was all about this notion that LBOs were going to become so prolific that they might actually eclipse public ownership of companies in America, which of course didn't happen. And post-financial crisis, I think the financial buyout industry has receded as a percentage of total buyouts. But of course, M&A itself has receded in total scale. The equity markets are back to where they were before the crisis and then some. And the debt markets have been red hot or white hot or whatever color you want to choose to describe the pricing of fixed income securities, including corporate and high yield, in the lowest interest rate environment that the world has seen in half a century or more. So those markets are very strong, and normally M&A has been correlated to those markets, certainly to equities, and yet M&A as a global industry is down some 35 or 40%, and the financial component of M&A is down considerably as a percentage of that. So somehow, I think we have returned to a concept that I would, for lack of a better phrase, call back to basics. And so I asked three of the smartest CEOs that I've had the pleasure of working with over the years to come and talk a little bit about what are basics when it comes to business strategy and building businesses and running businesses globally that drive decision-making on the M&A front. I like to say that nobody would want to be his own cardiologist, but everybody thinks he can be his own M&A banker. And yet there is an accumulation of knowledge that I think drives good thinking, best practices in a technical sense to be sure, but good thinking in a strategic sense, I think, is what we're going to want to focus on. So let me introduce, and then I'll take my seat alongside them. First, to my immediate left is Dinesh Paliwal, the chairman and CEO of Harman International Industries, the largest and leading player in audio, infotainment, and professional sound and lighting equipment in the world. They stock more technology into more automobiles, into more people's homes, and onto more stages than any company that I know. There was a moment in time when they were meant to be taken private by KKR just before the crisis. That didn't happen, and in the year since, Dinesh has added several $1 billion worth of value through adept stewardship of iconic brands globally and through strong strategic M&A. He is an alum of ABB, where he was the first Asian ever to serve on the board of that great global corporation. He is a member of the CEO Business Roundtable, a board member of great companies including Bristol Myers Squibb and ADT. So Dinesh has a tremendous amount of perspective to add to the subject of strategy and M&A. Similarly, my friend Russ Fraden was client of our firms when he was CEO of Hewitt. He is now CEO of SunGard, which of course has the strange pedigree of having been a great technology company incubated inside of a great oil company, LBO'd by Welsh Carson in 1983 for an amount of money that some New York apartments not far from here would go for, and then later brought public, and finally LBO'd in 2005 by virtually everybody who's anybody among the major cap buyout firms for an $11.5 billion price tag. And it is an amalgamation of really a couple of hundred businesses, and Russ was brought in just in the last period, very recently, to really rationalize that portfolio and ask the hard questions. What is it that drives our business in technology with a global footprint, to be sure global in every considerable way, just as is true for Harman and Dinesh's perspective. And finally, Bert Notini, who's been a client in so many businesses that it's hard to know where to begin, Bert. Bert is originally a deal lawyer, restructuring and M&A at the great Boston law firm of Wilmer Hale. He later became an executive in Wang Laboratories, of course, one of the leaders in M&A and in technology M&A. Later became president of Sonus Networks, where he was a client, CFO of Manufacturers Services, a contract manufacturer that we merged into Celestica, where he was a client, and now is a partner in New Mountain Capital, the $8 billion private equity group here in New York that owns, among other things, Aptus, where he was a client, Dell Tech Solutions, Camber Aerospace, Oak Leaf Waste Management, and so many others. So he has a tremendous perspective as well. So I want to start by asking the question of each of you to just give maybe a primer on how you've thought over the years. I've given you my take on it, how you've thought of the subject of strategy as it relates to building businesses through mergers, divestitures, acquisitions, rationalization programs, and so forth. What are you really looking at as a CEO of a major company when this shop-worn word strategy first comes up? What does it mean in your world as it relates to our topic today? Dinesh, maybe we'll start with you.
Sure. Thanks, Marshall. Pleasure to be here, first of all, and great panel and great group of audience here. So for me, for Harman, strategy is not just a buzzword, and we spend a lot of time executing strategy, but we also take serious effort to understand what is the DNA of the company. And I'll define it we have 5 strategy pillars. And since we are in a discussion of M&A is an enabler of our strategy. Every single 5 of these pillars, first of one is extend the technology leadership. Well, in the last 6 years, we've gone from 1,700 patents to 5,200 patents. So it's a very technology-rich environment. And so that's one pillar. Second is, how do you capitalize on iconic American brands like JBL, Harman Kardon, and many others? And the third is, how do you take advantage of opportunity-rich emerging markets, which hopefully will come more and more. I've had a pleasure to spend a lot of time in emerging markets, lived in China, Singapore, India, and other places. And the fourth pillar is really very important for all 3 of us here. How do you gain the cost competitiveness? Not just to take cost out. Cost competitors, as Jack Welch used to say, to be the profit leader, you got to be the cost leader. And how do you deploy your capital as optimized as possible rather than just getting into the winds and whims of what some of the activists might be saying, go buy back shares. And the fifth one, which is very important, is continue to look for diversification. That's where, again, M&A comes in very important. So how do I wrap the strategy? Well, the strategy is 5 pillars. We execute on them. And be impatient. Even the word which my corporate communications would tell me not to use it, be paranoid with the disruption out there. So again, what might be happening in Bay Area or in technology parks of Shanghai or Ukraine should drive me crazy every day, and that's what it is. So that should drive, what can I buy which will give me time to market gain? Because we can't develop and do everything ourselves, none of us. So my strategy more and more to work with people like Marshall, those who have a much bigger sort of view of the world, and they will know what's happening in the spaces of 3 verticals we operate in, and they keep bringing ideas to us. may or may not apply. That's one. Two is the talent. Because we are running into the talent war all the time. How do we get the best talent? That again, part of M&A. When I look at the targets, I look at not just it's a well-run business. Do I get good talent pipe with it? Because I have a philosophy. Every time I acquired a company, I have enjoyed the management and gave them more empowerment. So they have bigger balance sheet to work with. They have a bigger global channels to work with. So they feel empowered. So talent is very important. And third, which is very important, is we bring culture. Because if you don't assimilate these targets into your company as a part of the strategy, this would be a failed merger, and you will be looking at pointing fingers. Therefore, I'm a big believer in small to medium size, but many acquisitions rather than one large mega one, which will buy you time for 5 years, from some of the shareholders to sort of mess with it, and may work out. The jury is still out. But I'm a firm believer, do many, but do the peeling effect. Keep on adding layers so that your culture is seeping into the businesses you acquire. So that's how I define strategy and how do we execute.
Well, I think those are great pillars. I want to come back to some of them as we speak, Dinesh, particularly the subject of cost, because, I don't know how much in manufacturing you can really chase the cheapest labor markets around the globe. It's cumbersome to try to do that, and yet everybody wants to do that. Russ, in some ways you were a particularly appropriate choice, I say with a certain degree of pride in my trophy guests, because before you were an executive at ADP and Hewitt and now SunGard, you were a senior partner at McKinsey, and so you have a particularly rich sense of strategy. So tell us a little bit about how you think about that.
Marshall, I realized when you invited me here, and welcome to all of you, that you're getting old when you realize you were part of founding the strategy practice at McKinsey. So I think it was in the late 70s, there was a brilliant gentleman by the name of Fred Gluck, who's since retired, who became the managing director of the firm. And the definition of strategy hasn't changed through the years. Basically, think of it as sustainable competitive advantage. And when you think about strategy being a sustainable competitive advantage, I think Dinesh hit the nail on the head. There's two ways you gain a sustainable competitive advantage. One is you either have lower costs than your competition, or second, you provide more value. And those are the only two ways you can do it. And there's a lot of ways that you can chase the cost curve down. And if you look at what I've done since I came into SunGard just over the last couple of years, we've improved our margins by 300 basis points, and we brought the cost down, and we'll continue to do that. But that's not really my focus. My focus is all about the value end of the curve, and really understanding we serve the financial markets. They use our products for back office processing. They use our products for investment record keeping. A lot of the people in this room may have heard of the platforms that we have. And so I'm continually asking, what are the value we could provide? And then as Dinesh was saying, it becomes a buy versus make decision. Meaning, can I make the product faster, build the software myself, provide the services, or is there a logical acquisition candidate out there? I would say just in a temporal aspect to the strategy, you go through enormous swings in value. So, as you know, and you've seen me in other areas, right now, I'm more likely to sell something than buy something. Mm-hmm. Meaning when you look at the value end of the curve right now, people are overpaying. And you look at where they've chased the value to. In a lot of today's market, I'd rather be a seller. And we've driven up the value of the enterprise, even in the time I've joined, by slowing down the M&A machine, taking the costs down, paying off the debt. And we brought the value of SunGard up 46% now in those 2 years. And I think I've done 3 deals in 2 years.
And I'm glad you mentioned that. I had given a little bit of a primer on Harman and its 3 basic segments, but as long as this is an M&A conference and you're talking about the possibility of divesting businesses, maybe give the audience a sense of what's under the hood inside SunGard.
Well, I joke in SunGard that they made over 200 acquisitions in 25 years. And I remember when I first met the deal guy, he proudly showed me the list, and they'd spent $8 billion on all these acquisitions. The bulk of them are software and services for financial services. They also bought a lot of higher ed things. I sold that off. They bought a lot of things in K-12 education and public sector. And then, of course, we have the availability services business. I came into work the next day and I showed the deal guy, I said, gee, over 25 years, if you'd have taken the $8 billion and invested it in T-bills, do you know what it would be worth compared to SunGard today? And he looked at me and he said, I don't, but I don't think I want to know the answer to that question. And I said, you're right. You don't want to know the answer to that question.
Well, it's an interesting thing because, of course, SunGard was in some ways a roll-up. It was an acquisition, a series of acquisitions in related sectors of software and industry. And in rising markets, roll-ups can be very gratifying for financial entrepreneurs. And Welsh Carson was one. And in a sense, the public market was one. And ultimately, it was taken out by very large cap businesses before the financial crisis. And now you're looking at pruning, I think, is probably a good way to say it. You sold off the ed business. So strategy has to shape a lot of that thinking. We'll come back to that subject too. But let me let Bert say a couple of words as well. And Bert, in some ways, you're the archetype for this type of conference. You were originally a lawyer and then an executive running so many businesses in technology, and now a private equity guy. So you've worn all three hats, although you don't have three heads. You've seen this subject of strategy in M&A from all three contexts. Give us a little bit of a sense of how you would sum it up after your couple of decades in business.
Thanks, Marshall, and thanks for inviting me. It's great to be here today. Let me take a little bit of, I think my career is sort of a testament to ADD, I think is the right way to think about it. I'd say that, the venue or the sort of the space I have today is looking at the market from a sponsor point of view, from a financial sponsor point of view. And what I find interesting, having been at this for a couple of years, is that the parameters are somewhat different because you have to kind of get up and down on an investment within a very limited period of time. And so if you don't get it right at the beginning, it's pretty hard, no matter what you do, to get it right at the end. In the days when it was all about financial leverage, even though there's a lot of financial leverage out there, we're kind of over because that's a commodity now. It's very hard. The only thing that helps you do is overpay and hurt your returns. So what it leaves you with is, what we think about from a New Mountain Capital point of view, is a couple of things. We think about sort of just very, very deep focus on secular trends. Because we're a generalist firm, we can invest in energy, chemicals, technology, financial services, consulting firms. So we have no narrow mandates. So we look at where are those global growth trends, and then we combine that with relentless tactical execution. So what I mean by that is, in a market or an economy where growth is somewhat slow, it doesn't mean that there isn't any growth. In fact, there's a ton of growth. You can look at industries that are so transformational, like the oil and gas industry today. Who knew we'd be energy independent as a country? I mean, it's almost unthinkable. And then you think of all the things that follow from that. So if you take that as an example, we think about is, how do we take either one of our companies, or how do we enter into a company that has some of the capability to play that growth trend? And then we look, just as my co-panelists have mentioned, at how do I take those capabilities into sort of adjacent markets? But the key, we feel, and the critical pitfall oftentimes, is you tend to look at what that market's going to want from what your capabilities are, as opposed to getting out into that end market and looking back and saying, here's what the value proposition needs to be for those customers, and then how do I take what I have into it? Typically for us, buying an asset that brings domain expertise, a cultural appreciation, key relationships, is the way to make that bridge. So I'd say, we value very, very highly those that advise us and help us execute that strategy, but that's sort of the core of the way we create value for our pension fund limited partners. And it's sort of the exact same themes that are being hit. For us, it tends to be more focused on a specific idea in a very compressed time frame, and frankly, without M&A support for our bankers, our lawyers, all of our advisors, we can't get it done. So really happy to be here and appreciate all the help.
Well, it's interesting. I don't want to be overly reductionist, but did you all notice that the manufacturer to my left tended to focus a little bit on cost? The global technology guy in the middle and services guy tended to focus on value, and the private equity, newly installed private equity guy tended to focus on secular trends and where can you play. But with that as our stage, maybe, let's talk a little bit about the global economic situation. When you look to control cost, Dinesh, or when you look to find the right value, the right mix of businesses, whether you're pruning or reshuffling the deck or whatever you're doing with your mix of businesses, Russ, or when you look at secular trends, Bert, Where are we in the financial and economic landscape in which we're all doing business? Are we coming out of a recovery for real at this point? Is the equity market a leading indicator? Are we going back into growth? Is Europe ever going to be a growth continent again? Is this mostly about emerging markets when we talk about growth? We'll talk a little bit, each of you, maybe Dinesh, we'll start with you, about the global financial and economic environment in which we think about these issues.
Sure, happy to do that. I think we're in a much better place today than 1 year ago when Europe was reeling with their own ills, and I'm not sure they're out of them, but they're definitely, and Europe, we have to see, it's not one country. Europe is multiple countries. So UK is doing extremely well. I mean, they're growing, and they seem to find the formula that they can continue to have slow but sustainable growth. Germany has found their mojo, so they're, I think, doing fine. But then you have countries like Spain and Portugal and others, I think they'll struggle because they have fundamental issues to resolve. And we bit the bullet here in the United States, and I think that was hard, and we got on with it, and we're moving forward. So that's Europe. So we were quite pleased, actually, with the economic engines of Europe, or call it EU5. There we are seeing growth, not phenomenal, but we had factored, Marshall, negative growth, EU5. So we're pleasantly surprised that we're seeing 0 or 1% growth. So if Europe can continue to give 1.5% growth, I think we're going to be fine. Most companies would be very happy because they create a lot of growth outside. Then you go outside of Europe, I'll come to the US in the end, China. I think China, a lot of people started to write off China. I'm a big China bull, have been since 1986. China has fundamentals. A lot of people question, but I think they have much better handle on the economy, even if you call it whether it's a truly market economy or control economy. I think it's a very good best of both. And with the new leadership in place, I am definitely connected and hearing. I have a great leader from China on my board of directors who is a sitting chairman CEO of a technology company, Dr. Liu. So I'm close to hearing and understanding. I think China will easily give us compound aggregated growth rate of 7.5%, which is, for the size of economy, number 2 in the world, is a pretty damn good. I mean, we got used to 8-9%, but 7% is a pretty good growth. So that's China. Then you come back to the massive engine of the economy, the United States. I couldn't be happier. I think we can complain about it, that long term we are losing our competitiveness because of the immigration reform, because of the tax reform, which absolutely long overdue, because of the absolute paralysis that the earlier panel talked about in Washington. I think businesses are so robust that we have found our own ways to innovate and get going. So we're quite pleased with the US right now, and I see for next 3 to 5 years, even if they try to mess it up in Washington, I think we'll be fine. So I'm an optimist overall, but I'm an absolutely big bull on emerging markets, the BRIC, or actually BRICS, including South Africa. Brazil is doing very well for us. We've been growing for 5 years, CAGR of 25%. I looked at CAGR of BRIC, BRIC countries, for 5 years has been 11.5% CAGR. Our performance, our base was low, but our performance is 70.5% CAGR in the last 5 years in 5 countries. So I'm very happy, and we're investing heavily and actually looking for acquisition in these countries, not so much for the technology, but for the talent, for the distribution. But that's very important for the global company like us.
As long as you mentioned China, before we move to Russ, Dinesh, you mentioned Dr. Jiren Liu, and you and I were talking about him. He's an exceptional figure in Chinese business and technology. So he may not be prototypical from the answer to my question, but my question to you is, as a technology company, what do you see coming out of China in technology? I don't mean in manufacturing. I don't mean in replication of products and services that others have created, but in innovation. Where are they now in that piece of the cycle?
Yeah, it's a great question, Marshall, and we could really have a topic just on that. Because you could get into the IPR, you could get into do they really innovate, do they copy, how should you protect your Western intellectual property, we all very concerned about. Having lived in China for 5 years and actually served as an economic advisor to the governor in China, I think this China is very different than 20 years ago we saw. Because they are actually innovating a lot right now, and as the local Chinese companies start to innovate, they become the advocate for intellectual property protection. So until that happens, until the inner strength in China support the whole notion of intellectual property, we from West can do as much as we like, But you're not going to move Chinese machinery because they act when they want to act. So I'm very bullish on China innovating now. Now, not necessarily in the areas where our Bay Area in California, we all are coming out with a cutting edge technology, whether it's a next generation internet. That's what we are right now working on. We means as a country. China is not investing because these are high ticket, capital intensive research program, and the yield might be long out there, or medical research. But when it comes to products, and like look at the power generation. I come from ABB. Ultra high voltage power transmission. US is not investing, Germany is not investing, Japan is not investing, China is investing. They said we want to be the guinea pig. Because we have thousands of miles from north to south, from Three Gorges project to Shanghai, all the way to the western part. We don't want to have 30% losses, which we have in our country. We're the first world. So they deployed technology, a lot of intellectual property they developed, and we were part of that. So same thing I can say in a lot of equipment area, whether it's a PET scanners or other scanning technology, they are actually taking in medical area a very heavy-handed R&D approach.
And that's where Jared Liu has a particular expertise, which is unusual. It is interesting. I mean, I don't know whether it can be generalized to the broader categories that Russ is in. But Russ, I want to flip it over to you. And Dinesh gave you a lot of material to respond to. You can pick your favorite financial, global economic question, or your favorite tech question, or some combination. But how do you look at the global scene and including technology?
Well, a few thoughts. One, what I find interesting is you look at when the world ended. You know, if you look at sort of the 08, 09 timeframe to today, so, you know, we're almost 4 years out of it now. The economy's grown at 2% for 4 years. Hasn't changed a bit. And what's interesting is the market's reaction to the reality of 2% growth. Meaning we have swung wildly depending on the view of what Washington's doing or whether Europe's going up or down or whatever. But the U.S. has recovered at 2% a year for 4 years in a row now. And we'll finish this year at, guess what, 2%. So, you know, this idea that things are suddenly accelerating, or right now, I think the equity markets are in a bull cycle. People feel good, and that is good. But I think we're getting used to the reality of a slower growth environment in the U.S., period, end of sentence. I think that's a very sad thing because I think there are numerous things we could do to accelerate that growth that we're not capable of doing right now. If you look at what's going on around the world, I do agree that there are many more glimmers of light. We are investing enormously in emerging markets. And when you say emerging markets, because I'm more dependent on intellectual property than hardware, I'm less bullish on China. Meaning if you look at China, and you joke about what's coming out of China, what I see coming out of China is a lot of stolen U.S. software.
But I think, Dinesh, I thought you were really suggesting that there's the emergence of a rule of protective intellectual property law. Maybe you're not quite.
No. What I see is that if you look at we serve the Bank of China, and we serve J.P. Morgan Chase as an example. And if you take any big international bank, they probably spend 4 times as much on software as any Chinese institution. Meaning it's just not valued. It's not whether it's right or wrong. They don't value intellectual property. If they can steal it rather than buy it, that would be a preferred route in many ways. They wouldn't call it that. And that's why I say, I just think it's a different set of sort of norms that you grow up on. So we wouldn't look to make China enormous growth for intellectual property. I think anyone who's a software company trying to do that, if you look at the only market in the world Google's staying out of, it's China. And I think there's a reason for that. And by the way, if you're taking your normal cell phone or your normal computer into China, I wouldn't use it when you get back. That's just the reality of the world today. If you look at what's going on, where we're finding emerging market growth, is all of the surrounding Asian countries. So we're very big in Singapore, we're very big in Thailand and places like that. Interestingly enough, we're finding the Middle East is opening up like crazy. And so when you see, whatever you want to call the Arab Spring or whatever, we provide the software. Suddenly you're Libya, you need a banking system. I know that sounds crazy, but we work with the State Department, and then we provide that and help them reset up the banking system. So whether it's South Sudan or places you wouldn't think of, we really are on the cutting edge of that kind of stuff, and that provides.
So on technology and rule of law, you're not sure you see it as robustly as Dinesh does, but it sounds to me like on fundamentals of growth, Asia, and you're adding Middle East are really
Middle
good the way
East would be
Dinesh is
huge.
saying.
Africa, I think people underestimate like crazy. I mean, we had a great base. We have a wonderful base in South Africa. We're now using that to expand out into the rest of Africa. You know, if you're going to be in Latin America, you have to center yourself in Brazil. I mean, that's really the only large economy down there. And if you look at Asia, I think Asia is terrific, and I don't mean to underplay China. We have a huge presence in China. I'm just saying I wouldn't look to develop a lot of software there.
Okay,
it wouldn't be a great development
fair enough.
center.
After Bert gives a view of the economy, Dinesh, I want to come back to you on this whole subject of cost and whether you can chase the cost curve around the globe or whether that's a fool's errand today. Bert, tell us a little bit about the cycle we're in.
I'll give you a couple of different angles on it. So from an amount point of view, we have our private equity firm, which is the core of the business. We also have two other legs to our stool. One, we have a public credit fund, it's a BDC, where we're lending to companies, enterprises, and the other is a public hedge fund. So I'll kind of give you a couple of different perspectives. Because I'm not sure the macro side of it. I don't spend that much time doing it. I'm fortunately not an economist, so I'm going to back off that. But I will say, from the credit side, it looks very strong. Strong from a point, not so strong from a point of view of the yields we might like to see, but strong from a point of view of performance. And I'd say strong from a point of view of enterprises achieving their plans. So if you look across the board, it feels like there is some stability there. And on the margin, some strength. Not a lot. We're not seeing, and that may be a portfolio of, say, 100 or so plus, like middle market companies, mostly U.S. We don't see anybody knocking the lights out, but we see them all doing fine. So I'd say kind of okay. On the public equity side, we're of a view that this is a government fueled bull market. It is fairly heavily oversold, in that our concern is that as the government begins to take action, there's a lot of risk. There's a lot of value risk in the equity side. Whether that translates into value risk at the enterprise side sort of remains to be seen. I would say that as we look more broadly across the globe, again, starting from the point in time when the world came to the end to today, we would view the world as one in which governments are playing a much more muscular role in growth. So when you think about growth, it's important to unpack it a little more and understand how much of it is fundamental and how much of it is driven by government policy. We're still in a very much of a deleveraging world, certainly in the US and beyond, certainly in Europe. We're not out of the woods yet. So as we think about what matters from a growth point of view is, where is the growth? Where are the fundamentals that drive that growth? And how do you play that? So there is plenty of growth out there to participate in, but I think it's going to be a lot of mix between old declining and new emerging. And I think, for those of us that are running companies, putting capital work, trying to drive returns, there's going to be plenty of returns. But I would say it's going to be, you gotta sift through and find the jewels, because there's going to be just a lot of noise, particularly as we move now into a period where some of this free capital starts to get pulled back. That we would view as a very significant macro risk to growth.
Well, even if the financial crisis was made in America, the recovery seems to be made in America too, and certainly the reserve currency remains American. So we have a lot of advantages, and yet if you're chasing growth, you're going to end up in the emerging markets, as I think Dinesh in particular, but also Russ was saying. Dinesh, I want to come back to the cost side.
Sure.
Is it a fool's errand to chase the cheapest labor pockets and the cheapest venues for manufacturing in today's volatile world, or can you continue to do it? And you're as global a company as any, both manufacturing and technology.
Well, first answer is yes, you have to do it balanced manner. But before I weigh on it, just want to add a couple of things. As Russ said, you made a very good point, and I just don't want our audience to feel that is this way or that way. I think we're pretty balanced because we all run global companies. China is not what we expect. China may not be that in 5-10 years. They're not going to be in near future anywhere close to respecting IPR as the United States or Western Europe. But it's not generalized either. I mean, a different sector, they have different strengths. and they admit it. And the point I want to make before I come to cost, which is related to the cost, that China is one country where for record, they will pay you the highest dollars for the most authentic brand, the pure, the original items. Louis Vuitton, if you talk to their bosses, they'll tell you they get highest grossing Louis Vuitton store in the world is not in Paris, not in Fifth Avenue, it's in Shanghai. So again, this is the China who will say, I want most authentic product, I don't want copy, and I'll pay for it. So that's the tier 1. So China you can classify into 6 tiers. Then you get to the bottom 3 or 4 tiers, they have a very different need. You're talking 1.3 billion people. Let's say 100 million people are in the top tier, rest of them you have to fit into other 5. So for them, you need to have a reverse engineering, which is what Harvard Business Review and Tuck School, they've done a lot of work. The reverse engineering is take great Western technology, reverse engineer it, take the cost out, make it 1/3 of the cost it will take to make the product here so that you can treat the masses what they need for. It may not be everything what the top tier wants. Coming back to your last question, I know we have to respect the time here. Chasing the cost, I think we as a global company CEOs, that's our responsibility to take advantage for the cost arbitrage. But the fundamental is what we have learned from experience. You cannot go away from the customer proximity. We serve as a Harman, 80% of the world's luxury car market is with us. Entire German car industry, whether it's Daimler, BMW, Porsche, Audi, Ferrari, Lexus, and we need to be close to where their plants are. That means it is important to have one quality, that's a Harman quality. We have 3 plants in China, we have 4 in Mexico, we have 3 in the United States, we have 3 in Germany. So we will always be global. Our intention is not to shut down everything in US and Germany, go to China, that would never work. At the same time, we are tapping into some of the brightest sharp engineers in Ukraine, Russia, India, and some other parts of the world, where they may not have the same degree of experience as our American or German engineers, but they have the hunger. They have the speed. They don't look at the watch. They will work 12 hours a day and 6 days a week to get to the job so that follow the sun, when Americans and Germans wake up, the product is delivered. So you have to take advantage of that. And the key, the secret is how do you complement that sort of a mindset with the experience of American engineers and German engineers and make it work.
Well, I love the close to the customer as a good signing off note for this conference. And we do have to respect the clock, as you say. But maybe Russ, as the McKinsey man turned CEO, give us your piece of wisdom about this whole subject of strategy for running businesses. Dinesh is to stay close to the customer. And you're more, I think, on the value curve, but what's your important pearl for us?
Well, I think from the strategic standpoint, which is very different from the sponsor standpoint, and I work with both now, which
you sure do. You're owned by sponsors, but you got a lot of strategy under the hood.
Is that Dinesh hit the nail on the head, that from our perspective, you got to provide value to the customer. And so when we are searching for M&A opportunity, it's what's the customer want now. So I'll tell you a little secret. Having seen the Dodd-Frank thing pass, we're the largest provider of software to the financial services industry.
Wonderful business to be in.
We're looking for anybody out there that has companies that focus on compliance.
Yeah.
And so I mean, it's obvious. And so to me, it is the value to the customer. Our customer is financial institutions like yourself. So I'm looking for properties out there. If you're serving LPs, we not only want to make the accounting engine, we want to file the Form PFs as an example, that it's that next logical extension. And the further out you reach from where your customer is, the more likely you are to fail.
Boy, do I have a company for you, Russ, but that's not for the stage. Last words.
Why else would I have come?
Exactly. Last words of wisdom from our private equity investor, Mr. Notini.
Yeah, no, I think Russ and Dinesh have hit the nail on the head. And it is all about the customer in the end. That's what drives everything. That's how we organize our thinking. I think that's got to be the key of strategy, however we can get to the current customer and the future customer.
Well, look, you all are great friends, clients, business leaders, and you have a perspective. I was saying earlier as we were coming up here that David and Roger have really made this a conference of ideas, and I can't thank the three of you for sharing your ideas, and they are intellectually and commercially and financially fertile ideas that you bring forward. So Dinesh Paliwal, CEO of Harman International Industries, the great audio and now lighting business of the various sectors. Russ Fraden, the CEO of SunGard, one of the great technology groups in America and on the world stage, and a former CEO of Hewitt, senior executive of ADP, and senior partner of McKinsey, a great mind, and my dear friend Bert Notini, lawyer, executive, and private equity partner at New Mountain Capital, which I think, and I say this as full disclosure, they too are a client, but New Mountain Capital, I think, are among the smartest pools of major capital among the newer private equity firms to have been added so successfully to the top quartile of the industry. And I think what you guys are doing in looking deep into strategy is so important. That's what this piece that David kindly referenced is really all about. It's why is M&A slowing down, but why is it also more about strategy? And I think that these gentlemen were able to bring some real content and depth to that discussion. So I can't thank you enough. Thank you all.
Thank you, Marshall.
Great pleasure.
Nice to meet you.
Thank you.